Hello, everyone. I would like to welcome you all to the 15th of Istanbul Commerce University's Science and Society meetings. Today, we will talk about evolutionary finance and particularly evolutionary portfolio theory and practice. And for this lecture, we have a very distinguished speaker, guest speaker, Professor Thorsten Hens'i. I would like to introduce him very briefly to you. He's a banking finance professor in the University of Zurich. He got his PhD from University of Bonn. His research interests are evolutionary finance and behavioral finance. He has published in various prestigious academic journals such as Journal of Banking and Finance, Journal of Portfolio Management, and he also has close relations with the industry. He is the founding partner of the spin-off company Behavioral Finance Solutions. I think I wouldn't be exaggerating if I say that he's one of the pioneers of evolutionary finance in the world. So I think we're very lucky to have him today. So I will try to keep it brief and leave to Thorsten. Welcome again.
Thank you very much for the kind invitation, Serkan. I'm very happy to be at Istanbul Commerce University. Even I'm not in person there, but I'm on YouTube. And my little daughter says, when you're on YouTube, you're a real star. So this maybe counts more for my daughter than for academia.
She's definitely right. You're a star for us, at least.
Right. So my topic is evolutionary portfolio theory and practice, as Serkan was mentioning. And I did a picture on the first slide, which was in a Swiss newspaper. And what you see there is a caricature of Charles Darwin, who is running on the finance newspapers. And what is written as a subtitle is Thorsten Hens'i talks about evolutionary finance. Nobody else than Charles Darwin should be interested. So even if you're not Charles Darwin, I hope you're interested what this crazy professor from the University of Zurich is doing. So here's a list of some co-authors who joined me in this topic. As Serkan was saying, I think I'm one of the first to have initiated this project. And Rabah Amir, for example, he joined me on the game theoretic part. Igor Evzigneyev is a brilliant mathematician. He is very important in this project because he is instructive in all the proofs. Klaus Rainer Schenkope was an assistant of mine, is now also professor at Manchester, like Igor Evzigneyev. He's a very good professor in finance and mathematics. And then also some younger ones like Valeria Potter-Pova, for example. She's a PhD student of Igor. She has joined, or Nikolai Doskov, he's from practice. He's from the Bank of the Duke of Liechtenstein, or Florian Rümelein, a PhD student of mine. And of course, Enrico De Giorgi, with whom I have founded the spin-off company, this Behavioral Finance Solutions. And here you can see there are some dots. So I hope you feel encouraged by my presentation. And next time I present, I can put your name here so that you become a co-author of this fascinating project. I should also mention Ferhan here, the Ferhan Benli, who made the contact to Istanbul Commerce University. He got a PhD from University of Zurich, and it's very great that he still keeps memories of me and that he connects me to your university. Okay, so my presentation is structured by an introduction, and then I will go into evolutionary portfolio theory, the idea of this and the model, and then we do some applications, a conclusion, and then if you're interested to read more, there are some references. So let's start with a very simple question. So how should an investor allocate his wealth among various assets? So for example, you might have a million to invest. I don't say Swiss franc or Turkish krona, let's say a million. You have a million to invest. And there are many opportunities where you can put your money. You can put it into equity, into real estate, you can put it into gold, or you can put it into a fund, hedge fund, and so on. And the basic question of portfolio theory is to answer, how shall I allocate my money in one point in time, and how should I change the allocation over time? So that's a very practical question. Should you hold it cash? Should you invest it? And if you invest it, how should you invest it? And over time, there have always been suggestions for that question. For example, the Talmud, it says you should put 1/3 into equity, 1/3 into gold, and 1/3 into real estate. So a simple rule, splitting the wealth equally among 3 opportunities. It's also called the 1/n rule. If you split it equally, so no optimization, just split it equally among important categories like equity, gold, and real estate. Practitioners, they would say, well, maybe the best rule is to have 60% equity and 40% bond. For example, the Norwegian government fund, the so-called oil fund, was running a 60-40 rule for many decades and was very successful with a 60-40 allocation rule. This, of course, means when equity goes up, you have to sell because you might have more than 60 in a boom phase of equity. And when equity goes down, you will have to purchase some equity again. So it's a counter-cyclical strategy if you rebalance 60-40. Other suggestions, more deeper suggestions, were, for example, by Speer to do an allocation according to relative dividend yields. So for each asset, you look at the yield, bonds, for example, the interest rate which you get, or equity, the dividend yield which you get, or real estate, the rent relative to the price of the house, and then you should spread your wealth proportionally to relative dividend yields. So meaning if the interest rates are depressed, you go more into equity, and if interest rates go up, you go more into bond. Also, a very famous rule is to say, well, let's just index. So in terms of the asset allocation, this means your asset allocation is the relative market capitalization. So take an index like the Swiss stock market, then you would invest proportionally according to the relative market capitalization. So the big companies, Nestle, Novartis, and Roche, you put more money than the smaller companies like Barry Callebaut, which is doing the chocolate. So these are many interesting suggestions. And the question is, what can theory offer? Which suggestion should you follow? The simple 1/n suggestion, the 60-40, include some indicators like dividends, or just do a passive allocation and indexing allocation. And evolutionary portfolio theory is the recent advancement to answer those questions. So the view of evolutionary portfolio theory is that whatever you do on the markets, you will be in competition with others on the markets. And then we seek investment strategies that perform well in competition with those other strategies. So the view of evolutionary portfolio theory is not that you have to find the best position in an abstract market and the returns of the market, they are an exogenous process, but you view the market as an interactive game. So you do maybe 60-40, somebody else does 1/n, somebody else does relative dividend yield, and then you want to understand whether your strategic positioning, 60-40, is good in an evolutionary sense, so whether it accumulates wealth relative to the other strategies. So it's a game theoretic point of view. You view the market as a stochastic interaction of investment strategies. So that's maybe the most novel part of evolutionary portfolio theory. You give up the view that there is an exogenous market, but you try to understand the market as the interaction of those investment strategies. So what has this to do with biology? So I would argue that biology is a good role model for finance, a better model than physics, for example. So let's look at the biological evolution and let's compare it with evolutionary portfolio theory. So the first thing that Charles Darwin says is, you should look at the biological evolution in terms of species and not in terms of individuals. So it doesn't matter whether a certain rabbit is called Peter Rabbit or Serkan Rabbit or whatever. The individuals don't count. It only matters how many rabbits do we have and how many foxes do we have. That's the first insight of Charles Darwin. The individuals don't matter, but the species matter. And that's already very valuable input for portfolio theory, because in portfolio theory, this means not the individual investors matter, like a pension fund or the oil fund, which I mentioned before, or Serkan, Ferhan, you and me, but what matters is what we do. So what matters is the investment strategies. So this means if several investors follow the same investment strategy, they are one species. You have to put them into one entity and not the individual investors count. So that's very important to get rid of the idea that investors compete with each other. The first idea of evolution is the species compete with each other. This means in our language, investment strategies compete with each other. So this also means when you're a small investor, when you only have 1 million, it doesn't matter that you are small. If you do a strategy which is populated a lot, which is a very crowded strategy, let's say value investing, for example, then the returns will depend on the whole crowd in which you are, not only on your wealth, but on the whole crowd in which you are. I will give examples later where I can compute the impact of a new fashionable investment strategy called ESG investment or sustainable investing. And then my model can give you hints, how would the new strategy compete with existing strategies? Will it drive out, for example, value, or will it be good for momentum and this and that? So we look at the investment strategies which compete. So in biological evolution, the competition is for resources. So the foxes, they eat the rabbits, and the rabbits, they eat the crop and so on. So it's competition for resources, but in finance, of course, it's competition for market capital. So we all want to get rich. So we want to have the biggest share in market capital. So the investment strategies, they compete for market capital. Then in biological evolution, there are two countervailing forces. There's a selection force, like now, for example, the coronavirus has a negative selection impact on the human beings. There's a selection force, and there's a mutation force. There will always be mutations. There will always be new species coming around. So in our evolutionary model, the selection force is the idea of the survival strategy. So we try to figure out which strategies are best in terms of market selection, so which have the highest growth rate of wealth. And the mutation force will be modeled by evolutionary stability. So supposing the market is governed by a mix of strategies, is this mix of strategies, also called ecology of the market, stable in the evolutionary sense? So can mutants get wealth relative to the incumbents? So this is the paradigm which biology would provide for finance. And I hope you will see from my presentation that's quite fruitful to look at finance in this way: species, competition for market capital, selection, and mutation. So I should mention evolutionary finance wasn't my invention. Maybe evolutionary portfolio theory was my invention, but there have always been other models in evolutionary finance. For example, the heterogeneous agent models, which started at the Santa Fe Institute in the 90s of last century. So what they did is they specified a few ad hoc strategies, for example, those which you have seen on the second page, like 1/n or rebalancing 60/40 or indexing strategy and so on. And then they were running computer simulations to look at the resulting dynamics where these strategies interact with each other. The typical result is multiple strategies survive. There will be fluctuations like the fluctuations between foxes and rabbits, and this will create quite some interesting dynamics. So authors on this heterogeneous agents models is Brian Arthur, Doyne Farmer, Andrew Law. You might know, he has a nice book out now. He calls this the adaptive market hypothesis, evolution at the speed of thought. Or Blake Lebaron, or Brock and Hommes, Chiarella, Lux, and Levy. So they are all doing the so-called heterogeneous agent models. So there you also have different species competing with each other. You would look at survival and this and that. So what is the difference to what we do in evolutionary portfolio theory? We don't limit the set of species. So we also look at what happens with more strategies. So the typical mistake, I would say, of the heterogeneous agents models is that they do not include, for example, one strategy which we have found, which is the survival strategy, which accumulates the highest growth rate of wealth. And once they would do that, all the interesting dynamics would vanish. So what we do is, first of all, we do analytic work, we don't do simulation work, so we know exactly what is true and what is not true. So we do analytic work, and we don't limit the set of strategies. So we always can find better strategies because the pool of strategies is subject to innovations. And then what happens is that a certain strategy might drive out other strategies and kill the interesting dynamics from the heterogeneous agent models. On the other hand, you can also look at the question of survival in general equilibrium models. The general equilibrium models, they are based on the assumption of intertemporal utility maximization with perfect foresight. So this, I would say, is a strict limitation to the way strategies are generated. If you only generate strategies under this assumption, then many, many interesting strategies, for example, the 1/n strategy, will not be part of the competition. And we know empirically the 1/n strategy is a good strategy. So this is a huge limitation to limit strategies this way. Authors in this general equilibrium selection is Bloom and Easley, Zandroni, Emanuela Scuba, and many others. So they do the traditional general equilibrium model with perfect foresight, and they ask what happens, who is the best survivor, what is the best utility function, what is the best expectations which you could have. But you should notice also, it's a very, like in the heterogeneous agents models, it's limited to a very specific way of generating strategies. And of course, it's a quite demanding assumption to have perfect foresight. When I talk to practitioners and say, yes, let's assume we know the prices of the future, they say, well, if you assume that, you can get infinitely rich, so there's no point for discussions anymore. So that's a theoretical argument, but practically this doesn't mean anything if you use utility maximization and perfect foresight. Okay, so let's come to our model. So what is the beauty of our model is we start from observables. So the first question is, what can we observe in real markets? We cannot observe utility functions, we cannot observe expectations. So that's why we don't do models with utility function expectations, because it's so hard, so it's not possible to observe those things in the markets. But there was great work by Farmer and French and others, for example, and they show that even if you have thousands of assets, for example, thousands of stocks from an equity universe, there are only a few factors who can describe the dynamics of these thousands of assets. This is a Farmer-French factors. So one of the factors is the market factor, meaning the index. One of the factor is the size factor, small minus big. The other one is the value factor, high minus low. The next one is the betting against beta. So low beta is a factor, the quality minus junk is a factor, the momentum factor, and so on. So that's a very important and practical result. If you have 2,500 assets, which we also use in our application, so we have 2,500 stocks in 14 countries, you would have thought, well, if worst comes to worst, you need 2,500 different stochastic processes to describe the dynamics. But farmer friends show, no, it's much simpler than that. You only need maybe 10 or maybe 11 or so factors describing the dynamics. And now you see what we will do. We will use the farmer friend factors, which are observables. There are strict rules how to form the market portfolio, the size portfolio, the value portfolio. So we will use those factors as the strategies in our evolutionary model. So then we are a good empirical foundation, and we can do something practical with the model because we know what are the factors driving the dynamics of the assets. Moreover, there's other work, for example, Frazzini, Kabila, and Pedersen. They systematically show that famous investors, for example, Buffett's strategy can be written in terms of those factors. So Buffett can be written, he has some exposure to the market factor, to the value factor, to the low beta factor, the quality factor, and so on. So this means if you want to start a model with investors like Buffett or the Norwegian pension fund and this and that, you can do what Charles Darwin would recommend. You can say, okay, let's see what they do. We can describe what they do in terms of a few factors. So let's write the model in terms of factors and not in terms of investors, because the strategy can be written as a combination of those factors. So this is the idea of our model. Let's start from some observables in the market and not from some fictitious things like utility functions or expectations. So now I have three equations in the evolutionary portfolio theory model. Just to explain you, they're not very complicated equations, but the first equation is the attribution of what investors do in terms of factors. So let's denote by lambda ITK the percentage of wealth which investor I allocates to asset K in period T. So if you were to do a pie chart, for example, that's the asset allocation in a pie chart. So how would somebody split his wealth in period T among the various assets K? So that's the main entity, the main notation of our model is this lambda IKT, the percentage of wealth which investor I invests into asset K in period T, like 60-40, then the lambda ITK is 60 for equity and 40 for bonds, or the 1/3, 1/3, 1/3, the lambda IK would then be 1/3 for equity, gold, and real estate. So in general, and this is the result of Frazzini, Pedersen, and others, you can write now the strategy of an investor as a combination of those observable factors. So that's a decomposition. The strategy allocation can be written as a combination of those factors. So this is saying there are combination weights, the alpha IF T, which combine the factors so that you can describe what an investor is doing. So that's the way to get rid of the idea of the investors, to get the model simple in terms of factors, because you assume whatever an investor is doing can be decomposed into those factors. So then we get that the market capitalization, so the relative wealth which is invested in Nestle, for example, relative to all the other wealth in the market which is invested, so the relative market capitalization is the average investment according to those factors. So this is a simple identity of demand equals supply. The relative market capitalization would be the average wealth invested by the investors I according to the relative wealth, but if we switch to factors, it can also be written as the relative investments by those factors. So to switch from individuals to factors, because of the decomposition of alphas, this is the relative wealth of a factor. That's all the wealth of the investors multiplied with the proportions which the investor allocates to a factor. So this equation 1 is nothing magic. This is just saying in every period in time, there is an equality between demand and supply. All the shares of Nestle, Novartis, UBS, and Tesla, all the shares will be held by someone. They will be held by investors, of course, but since the investors follow strategies, they will be held by strategies. So you can write the supply of the assets in terms of the demand, in terms of strategies. Okay, then the definition of the return is that this is the price of the next period divided by the price of this period plus eventual dividends which you get. So now you might multiply the price equation with the total amount of assets outstanding, and then what you get is the market capitalization plus the total dividend divided by the market capitalization. So that's the definition of the returns in terms of prices plus dividends multiplied by the number of assets outstanding, and then it's in terms of market capitalization. And finally, the wealth changes over time. So if a certain factor has a certain wealth in period T, then how do we get the wealth in the next period? Well, the wealth in the next period is determined by the returns which a factor makes according to the lambda allocation which the factor does. So this is the evolution of wealth over time. And again, that's not an assumption, that's just bookkeeping. If a certain factor in period T has this relative wealth RFT, then with those returns and his asset allocation, the factor will have that relative wealth in the next period. So these are the three equations which we use. Equation 1 is demand equals supply in every period, but written in terms of factors. Equation 2 is the definition of returns. So that's how you would define gross returns. And equation 3 is bookkeeping about the wealth of the factors. So that's the only thing we assume, or the only thing we do. We don't do maximization, we don't do expectations, so we just look at the world, how it is, and we discover it's a combination of those three equations. And if you combine those three equations, I don't have time to do it now, but what you get from this combination is a nonlinear random dynamical system. So that's the first order difference equation, which is stochastic because the dividend process is stochastic. And then the question is, how can we solve this nonlinear random dynamical system? But this is a natural dynamical system. I have talked to many mathematicians, they work on dynamical systems which are interesting for them from a mathematical point of view. And I always try to convince them to work on this dynamical system because it's so important for finance and not just because it's interesting from a mathematical point of view. But fortunately, my colleagues, Igor and Klaus, for example, they're good mathematicians and they know how to prove theorems on nonlinear random dynamical systems. Okay, so what are the solution concepts? I mentioned the word game theory. So we view the market as a dynamic interaction of investment strategies. And then you might say, well, game theory has a solution concept, which is the Nash equilibrium. So the Nash equilibrium would be that supposing you know what the other strategies are doing, you choose your strategy in order to maximize your utility or your payoff function given the strategies of the others. But this Nash equilibrium doesn't really help in our context because then you would need to have payoff functions and you would need to assume that one strategy knows what the other strategies are doing. So this doesn't really work if you have the evolutionary model. So instead of doing the Nash equilibrium, we look at so-called evolutionary stable strategies. So the thought experiment here is, suppose the market has a certain combination of strategies. So like you see here, the market is composed out of factor strategies lambda f take k with relative wealth r. So this is the ecology of the market. now imagine a new strategy comes along. So for example, now in Switzerland, in Scandinavia, and in Europe, many do the so-called ESG investing. And now you can ask, so what happens if a new strategy enters the market? So that's evolutionary stability. A mutant is coming along, is entering the market. And the question is, can the mutant grow at the expense of the incumbent strategies? Evolutionary stability means the mutant cannot grow. The strategy or ecology of a market is evolutionary stable if no mutant can grow against it. So that's one solution concept for dynamic interaction of strategies. The other solutions concept is the survival strategy. The strategy is called a survival strategy if it attains the highest growth rate of wealth. So that's quite demanding. So I'm not talking about the highest Sharpe ratio, or what, but I'm talking about the highest growth rate of wealth. So if you have the highest growth rate of wealth, it's clear you will survive in the market. Nobody else can dominate you. Maybe you dominate others, but survival certainly means you need to have the highest growth rate of wealth. Okay, so here are the theoretical results, and then I switch to the second part, which is the practical applications. So on evolutionary stable strategies, we find one strategy which we call lambda star, which invests according to the expected relative dividends. So the Ds which you have seen before. And this strategy lambda star is the unique evolutionary stable strategy. So in traditional finance, the expected relative dividends rule is called the discounted cash flow rule. So the first result which we find is efficient markets which are governed by the discounted cash flow rule, they are more stable than inefficient markets. So this means the old vision of Adam Smith that everybody tries to do the best for himself, and still it doesn't yield a chaos because of this stability property. The efficient markets are more stable than the inefficient market. Every now and then there is an exogenous shock to the markets, like the Corona crisis, for example, but then the market adjusts again, has found the new way to price in the exogenous event, and then it's stable again. So that's evolutionary stability. And we can prove it for any strategies and for any dynamical system. So it's a quite general proof that an efficient market is more stable than an inefficient market. Inefficient market, for example, is a market which has a speculative bubble. So in a speculative bubble, which you see every now and then, for example, on Bitcoin, the Bitcoin price rushes to $40,000, for example, recently. That's not a stable situation. That's a speculative bubble. And then there are mutant strategies which can enter. So some short selling strategies, for example. So that's not a stable situation. The other thing which we figured out theoretically is that this, let's say, fundamental strategy, investing according to expected relative dividend, is also a survival strategy. And it's unique among all basic strategies. So if you don't, basic strategies means if you do strategies which only depend on the random stochastic process and not on the endogenous fluctuations, so then this strategy only depends on the exogenous random process, and it's a survival strategy. It attains the highest growth rate, and it's unique among those strategies. So again, this is quite an interesting property that we can figure out for whatever dividend process, for whatever ecology of the strategies with which you are competing, there is one strategy, namely a strategy which is doing a fundamental rule, a simple fundamental rule, which achieves the highest growth rate. And again, as I said before, the many heterogeneous agent models, they don't include this strategy. So they have interesting dynamics between momentum, for example, and value investing. But if you were to include the strategy, the interesting dynamic is gone, because this strategy would govern the market, would achieve the highest growth rate of wealth. So if you're interested in those theoretical results, I think there are great achievements their good mathematical statements, convergence results, and this and that. There's a survey article by Igor Evzigneyev, me, and Klaus Schenkope, where you can read how to prove those results. And we are still doing advancements. For example, the recent advancement is that here, if you look back to the model, we allow the dividends to depend on the prices. So this is an important feedback effect, which is out there in the real world. If your company has a high market capitalization, a high price, it's easier for you to do a seasoned equity offering so that you can invest more into interesting projects. So there is a corporate finance feedback effect in the recent paper where the dividends which are exogenous in the standard models, in the heterogeneous agent models and in the general equilibrium model, the dividends now get endogenous. And we have published that in a very prestigious journal, the Proceedings of the National Academy of Science. So that's also nice to see that scientists are interested in our research, not only people in finance. So scientists thought, oh, that's an important thing which everybody in science should know, the Proceedings of the National Academy of Science. Okay, so far the theory. So it was a bit quick, the theory, but I hope it was an appetizer for you if you're finding this interesting. Read the survey paper, for example, or read my simple papers on that. There's a lot of things to do still also on the theory. But now let's go to the practice. Let's do some applications. So the first question, which I already mentioned on the way, is this idea of the evolutionary stability. And here is a practical paper which I have written with Nikolai Doskov from LGT, the Bank of the Duke of Liechtenstein, Florian Rümelein, a PhD student of mine, and Klaus Rainer Schenkope from Manchester University. So here we ask the question, what is the impact of Greta on Warren? So here you see Greta. I don't know whether she's known in Turkey, but in Sweden she's a star. So the Friday for Futures Greta, right? And she is sort of characteristic for the ESG investing, the sustainable investing. And here you see an old guy, Warren Buffett, who is one of the best investors ever. So out of $1 which you invested with him some 65 years ago, he made $65,000. Huh? So he's quite a good investor. But now a new girl comes into the picture. She says, no, let's do sustainable investing. And the question here is, how does it impact, for example, the value investors? So that's one typical evolutionary question. There is an ecology of the market which has value investors like Buffett, for example, and a new strategy comes along, the sustainable investing strategy. And now we want to check the stability of the incumbents. So will the new strategy grow? Will it be harmful to the old strategies, or will it be good for the old strategies? Could also happen. So this is to say, what are the trends in asset management? The answer is the recent trend is sustainable investing. The former trends were, for example, active strategies based on Markowitz. This was done from the 50s to 2000 to hunt for the alpha, for example. Then came a wave to hunt for the beta, passive investing according to the CAPM. And then a new wave was substituting the beta with those factors. So Farmer French said, no, there's not only one factor, the market factor in the CAPM, but there are many factors. So this was the smart beta. But now it's the gamma, I would say. So from alpha beta to smart beta, I think now the current fashion is the gamma, meaning to invest according to criteria, the social governance and environmental criteria. So this is called sustainable investing. And here are some charts to say, indeed, this is important now. For example, this is from Switzerland, billions of Swiss francs, which are invested according to this sustainable strategies or sustainable investing. It's growing exponentially. There's a huge awareness now in Switzerland. People want to invest according to ESG. They don't want to invest into child labor. They don't want to invest into companies which spoil the environment and this and that. So this is the ESG filter, so the ESG investments. And also, if you look at worldwide, the chart worldwide, the ESG investment has a take off now. Many people invest actively and passively into ESG. If you Google it, ESG investing or sustainable investing, you also find all the countries, all the people are interested. What is this ESG investing? Okay, if you do empirical work, you start off with hypotheses. Huh? So if you do theoretical work, you start off with assumptions, and then you derive theorems. But in empirical work, you start off with hypotheses. So one hypothesis could be the increase in sustainable investing has no impact. It just doesn't change anything if there is more wealth invested according to sustainable criteria. The second hypothesis is the impact on value, which is high minus low factor from Farmer French, is negative. So why would this be a well-founded hypothesis? Because the value investors, they have quite some overlap with ESG investing. So if you look into the portfolio of Buffett, he has old companies, and typically old companies are already aware of ESG criteria. The new ones, the momentum investors, they are typically not so much looking at ESG criteria. And the third question is the capacity of sustainable investing is not yet exhausted. And so some people say maybe every strategy has a certain capacity. So if you do too much value, the returns go down. If you do too much ESG, the returns go down. So where do we stand on ESG? Is it already too much return-wise? So is the capacity already exhausted? Meaning would more ESG investment mean less returns in the future? So these are the three interesting hypotheses which we try to answer with our model and of course with empirical data. So if you recall the model, there was the equation 1, which was given the market capitalization as the relative wealth of the strategies. So how do we do the so-called impact test? So how can we check what is the impact of a strategy on other strategies? Well, we do the following thought experiment. We change the market capitalization by allocating wealth from one strategy to the other. So the original situation is this: the relative wealth of the factors is given. There are, let's say, 5% value investors and maybe 50% passive investors and maybe 10% momentum investors and this and that. And then we want to see what happens if a new strategy comes along, or if we do allocations, if there's more in value and less in momentum and this and that. And then we use our equation 1. So it's a very simple equation. So we can reallocate wealth between strategies. And the amount by which we do it, it's called epsilon. In the application, it will be 1%, for example. So what happens if 1% of the wealth from a certain factor F is moved to a certain factor J? So that's the thought experiment. Well, if you change the market capitalization, then you also change the returns. So this is new returns then, because the definition of the returns was dividends plus price divided by price. And if you multiply this, that's total dividends plus market capitalization divided by market capitalization. So this means you also have changed the returns. And then you can compute the performance of the strategy with these changed returns. And that's the impact test. So the back test would be compute the performance of the strategy with the given returns, no changes in the relative wealth, and then we change the relative wealth, and that's what we call the impact test. Okay, the data which we use is a huge data set, as I mentioned before. The S&P Capital IQ Premium Financials data, from monthly data from December 2004 to the end of 2019. We use so-called point in time company fundamentals, so there's no backfilling bias and this and that. Also, the returns and accounting data are point in time, so this means we keep track of survival biases and all those things. These equities are from 14 developed markets. There are 2,500 firms in our universe, and we cut off 2 small firms. So we only look at large and mega cap firms. So there's a lot of noise in penny stocks. So we cut off at 2.5 billion market capitalization. And we use the 3 months treasury bill as the risk-free rate. So this is the ESG data which we use is from Thomson Reuters, Affinity. And here's the construction of the portfolios. The Farmer-French way of constructing is to look at the 70-30. If we have a criterion like, for example, the book value, the 70 highest, the 30 lowest, but we do a 50-50. And then, of course, data is always dirty. You have to winzerize, meaning there are potential outliers in the data which don't make any sense. Maybe it's just a mistake in the data. So we winzerize at 3 standard deviations, meaning we have most of the data in our data set, but totally useless data, which is logically not possible, you have to kill. That's the data work. And then the strategies which we consider is a passive strategy, market capitalization, the Talmud strategy, the 1/n strategy, the dividend yield strategy, the relative dividend strategy. And then we look at long-short strategies, the standard Farmer-French value, size, the momentum, the quality, and we enlarge this by the ESG strategies, like only environmental criteria for sorting, only social criteria, only governance, or ESG, or a combination which was suggested by Thomson Reuters. This is our own combination, ESG. And there's also a combination called ESG controversies. So this is data from the internet where people go through the internet and see which company has bad news or bad press on ESG.
Professor Hens, can I ask a quick question?
Yes.
Just to make it clear, what is the difference between the ESG score and an ESG combined score? Because as far as I recall, the ESG score is kind of a combination of the E, S, and G dimensions.
Yes, so the ESG score is our combination, and the ESG combined is Thomson Reuters combination.
Okay, what kind of a method, very briefly, did you use your own combination? I mean,
well, I don't know how Thomson Reuters does it, but what we do is we screen according to 3 criteria simultaneously. So it's double sort or triple sort. Mm-hmm. And then we do long and short on those criteria.
Okay.
So that's how we do it. But the interesting thing, it doesn't depend. So the results are the same, whether you do our sorts, whether you do Thomson Reuters sort. It's a little different to the internet sorting, these companies who go through the internet to check whether you have bad press on ESG. But the standard ones, they are similar. Okay, so now the first thing is, of course, the back test. So let's see how the strategies would have performed in the period from 2005 to 2019. So the market, the indexing would have gotten you 7.8% annual return. And then you see the 1/n strategy gets a little less, the dividend yield gets higher, that's nice. Relative dividend gets higher, the value wasn't good in that period, the size is similar, and so on. And also, that's interesting, the ESG, they did outperform the market. So whatever way you were sorting it, except for this controversies thing, which is the internet controversies on the companies. But if you do standard ESG sorting, you would have made a higher return than the market. So this is nice for ESG guys, because They do ESG, first of all, because they think it's important for the environment, the social and the governance. And secondly, they get rewarded for it. And they get a higher return than the market. So this was a nice period for ESG. They got a double win, if you like. They got the, let's say, the moral win that they don't invest into things which are bad. And they also get a financial win because they were beating the market with these strategies. And here's the higher moments, the volatility, skewness, kurtosis, and so on. Okay, then the backtest of the long-short strategies. Of course, long-short cannot have a return like the market because it's always long in half of the assets and short in the other half of the assets. So if long-short is positive, this means you're beating the market. So value we have seen did not beat the market, but quality is beating the market, and you see E is beating the market, S and G is beating the market, and so on, but not these controversies. Okay, now comes the impact test. So here what we have computed is we have allocated 1% of market cap into E, for example, into the strategy which forms a portfolio according to E, which goes long in those which have nice environmental scores and short which has nasty environmental scores. And then what you see this increase would help value. So we had one hypothesis that Greta is bad for Warren, but it's the other way around. So if you have more people investing according to environmental concerns, the returns of value will increase. So that's the impact. The returns of value will increase. Also the size, returns of the size portfolio will increase, momentum will suffer. And what is interesting, the more people invest according to environmental concerns, the worse will be the returns for that strategy. So there's a negative capacity, so a decreasing capacity. So that's the most significant part here, saying, well, you have been lucky the last 15 years that you were able to beat the market, but the more people are doing this, your returns will go down. There's a negative impact on yourself. So that's an interesting finding, which we also find for social screens, for governance screens, and also for combined. So if you combine all this, so if you do a proper sustainable investing with all criteria, it's bad if many do this. Maybe you shouldn't tell it so much to the others. So because it's a negative effect, it's quite a crowding out effect. Again, it has a positive effect on value. That's what we not have thought, has a positive effect on size. And then it has a negative effect on momentum. But interesting, it has a very negative effect on itself and on the other ESG strategies. So this is the first result. And here's the t-test. You see all the t parameters are significant, above 1, 2, 3, and so on. So I have to skip this. But the first result is that ESG has a positive impact on value, it has a negative impact on momentum, and it has a detrimental impact on its own. So be aware when you're an ESG investor, it was a good time for you, but the future will not be bright in terms of returns, because if more and more do this, it's quite a negative impact on yourself. Okay, Serkan, now you have to tell me about the time.
We're doing fine. We have at least 15 minutes.
15 minutes, okay. Because now the next application or the second application is not only to do the ESG strategy, but to look at the full picture. So what happens if one strategy is increased and what is the other packet, other strategy is increased, so get a whole impact matrix. So now for the ESG, basically we only have looked at one column. So we increase the assets under management in E, and we look what happens to value, size, momentum, and so on. But we could also have increased the asset under management in value and in size and in momentum. So once you have done this, you see, oh, there's a huge matrix. So everything can impact everything else. So that's what we do here in this project. And the application of this project is then so-called factor rotation. So what you see here is which of the Farmer-French factors was best and which was worst from 2003 to 2016. And you see it's jumping around. Sometimes the size factor is best and the low volatility is worse. Sometimes the low volatility is best and the size factor is worse. Sometimes value is good and so on. So the Farmer-French factors, on average, they make a higher return than the market, but they are jumping like crazy. Sometimes one factor is better than the market, sometimes the other factor is better than the market. So this gives the question, what is the best way to do factor rotation? So shall I do all factors and ignore the dynamics which you see here? Or is there a way to say, well, next year I think value is doing fine and quality is doing bad? So this is the research question. And we answer the research question with our evolutionary finance model, because the evolutionary finance model will be used to compute the so-called impact metrics. So what is the impact of value on size, on momentum, and so on? And then we do the third equation, the relative wealth, the dynamics of relative wealth, which we use to apply to the impact metrics to make predictions for the next period. So that's a quite interesting application. We can do factor rotation with this model. So this is a paper with Enrico De Giorgi, Nicola Doskov, Florian Rümeley, and Klaus Reiner-Schenko-P. Okay, so the data is basically the same, but we could start now with 1995 instead of 2005. Why? Because we had to cut to 2005 because we didn't have ESG criteria before. But now, if we only look at Farmer-French factors, we can compute the Farmer-French factors on the whole data set. So in this Greta application, we were restricted to having ESG. But here in this part, we don't include ESG, so we can do the whole data set. We have real transaction costs and this and that, so that's the data set as before, but the whole data set. Again, we do the point-in-time data, we do the whole sample, we do all countries combined, and we do cash flows and net issuance. So what I call D can also be cash flows and can come from seasoned equity offerings and buybacks and all these things. So the controls which we do is with survivorship bias, and we split it in two subsamples before and after the financial crisis. We look at this country by country, and we only look at dividends, so we don't do buybacks and those things. But these are robustness checks, so the base scenario gives you the main result, and then you see it's robust to all these controls. We do the same cleaning of the data, the winds arising, to get rid of this funny data from penny stocks and so on. And the strategies which we look at is the indexing strategy, so the market, the Talmud strategy, the 1/n, the dividend yield strategy, which I mentioned, which is from SPARE, the relative dividend strategy, which has the flavor of our theoretical strategy, the lambda star strategy, the momentum strategy, the book to market, which is Farmer-French high minus low, the size strategy, a quality strategy, and so on. And the first result is the back test. Now on the whole data set, the market made 8% per year, which is nice, I think. 8% in all those years. There had been quite some crises on the way, the dot-com bubble and the financial crisis and so on. So 8% is quite nice. But the Talmud strategy would have made 9.1%. So the 1/n strategy again is beating the market. The rationalistic strategy, the dividend yield strategy would have even made more, 11%. The relative dividend strategy, 9%. The value strategy, now there was a good value time before 2005. So also the book to market strategy would have made more than the market. the momentum strategy and the quality. So that's the best thing if you have quality criteria, EBITDA and other criteria, that's typically the best. These are the long-short strategies. Again, you should not expect them to beat the market, but if they are positive, then this already means they are beating the market. Okay, so this is the first impact matrix which I show you. So this is now the idea. If we increase the market capitalization, what is the impact on the market capitalization, on the 1/n, on the dividend yield, relative dividend, book to market, size, momentum, and so on? And the answer is, if you reshuffle from the market into the market, nothing happens. So this is confirming would have been disturbing if we find something here. The second column means if we reshuffle from the market into the 1/n strategy. So you see it has a negative impact on itself and also a negative impact on many other strategies, the equal allocation strategy. Then we have the dividend yield strategy, which also mostly has negative impacts. The relative dividend has some positive impacts. The value strategy has some positive impacts, and the size strategy is nice to itself. So that's important to know if you're investing into small caps, and if you can convince others also to invest into the small caps, the price of the small caps will go up. So that's good for you. The momentum is quite bad. This cross-sectional momentum, this is quite bad. And quality, which has been the best in the backtest, is quite dangerous. If you find the best criterion from the books, and if you tell others also use this criterion, the maybe cash flow yield or whatever, it's quite bad because there's a lot of crowding out on those criteria, the quality criteria. We can also do the same, including the long short. So what happens if there's more values going into the long short, like the long short value, long short size, long short momentum, long short quality, and so on. So then this gives the whole impact matrix. That's the impact of every strategy on every other strategy. On the diagonal, you have the self-impact. Okay, in particular, if you zoom into the long short with the long short, so this is the lower right corner, you find something interesting which was also observed by Asnes and others in the Journal of Finance, namely that value has a negative impact on itself, but a positive on momentum, and momentum has a positive on value and a negative on itself. So this is exactly the Lotka-Volterra dynamics, which I mentioned at the beginning, the rabbits and the foxes dynamics. So this is exactly what you see in the data. The rabbits, foxes dynamics you see between value and momentum in the data. That's just to remind the biologist. So there is something going on in biological terms. Okay, to conclude, the next thing is where to get the relative values from, which we have in our equation. So the relative values we get from factor regressions. So the return of any asset K, since this is Farmer-French, can be written as the allocation to those factors. And the betas are the Farmer-French betas. So let's say the return of Nestle can be written as the return on the market factor, the value factor, the size, the momentum factor, and so on. So this is Farmer-French regressions. So for each asset, you can regress it on those factors. And then what we do in order to get the relative values, which is important in our theory, because the strategies compete for relative values, we add up the lambdas, the betas, which you find from the Farmer-French regression according to relative market capitalizations. So if a certain factor is more important, this is figured out by the beta, what is the importance for the returns. And then you have the importance for many assets, and then we weight the assets by the relative market capitalization. So this gives us the R's from our theory, the relative market capitalization for the factors. We get it from data. And so we don't need to inspect the portfolio of the investors to see how do they allocate it, but we get it indirectly from the farmer-friend regressions. We get it from the data. So that's quite nice. So here's a chart where you see this. So how the size, the value, the book to market, so the momentum and so on, the betting against beta. This is the relative wealth which we have figured out by these farmer-friend regressions. Okay, and then what we do in order to do the factor rotation is the following construction. So we do the prediction model on the relative wealth based on this data which you have seen here. There's some nice regularity here. We do a prediction model based on the relative wealth. Then we have the impact matrix, and the impact matrix tells us what will the future returns be on the various factors. So that's the impact matrix, where in each column you have the thought experiment. What happens if we increased the relative wealth of factor 1, 2, 3, 4, 5, and then we predict which increase will happen in the future from these regressions which we did here. So that's how we can do factor rotation. Now we have an estimate on the returns of the factors in the future. And here you see that the strategy works. So here you see the market return. If you were just indexing, if you were just buying and holding this market in our universe, here you see the 1/n. It's also not bad. So the old Talmud strategy is the red one, the 1/n. So if you allocate equally in all factors, this is also what Asnes, Moskowitz, and Patterson in the Journal of Finance suggest. They say there's no way you can do factor rotation. The best thing to do is 1/n into the factors. And we say, no, guys, there is a way. You can use our model and use the data to do a factor rotation strategy, and we will beat you. So that's the factor rotation strategy based on the evolutionary model. Okay, I think it's time to wrap up. So what I wanted to convince you about is that using evolutionary concepts in portfolio theory is a natural step to do. So that's nothing unusual. If you talk to people who are not from finance, like from science, the proceedings of the National Academy of Science, the referee said, it's very good that you didn't use utility functions. For them, it's a natural step, because these fictitious things of utility function expectations, the national science people, they would say, no, this is only a fictitious thing. Rather work with what you can observe. That's a natural step to do. Evolutionary portfolio theory explains fundamental valuations are more likely. So that's confirming Adam Smith against Marx, let's say. Marx was saying the capitalist system will destroy itself, but Adam Smith was saying, no, 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 there is an inherent stability, and that's what we show in the theoretical work. And it allows in empirical applications to study the capacity and the cross-impact of factors. In particular, it allows you to do a factor rotation strategy. And of course, more applications should be done. So I hope this presentation was interesting to you, and maybe you like to join me on this project and we can do more applications on the evolutionary finance model.
Thank you very much.
Let me mention a hedge fund. Two students of mine have set up a hedge fund based on those principles, and they started recently. So they started last year in October, and already they made some good returns. But maybe it's not robust, so we have to see how it works in the long term. So the hedge fund is called Ionit, a Greek word. I don't even know what it means. I always have this idea to have strange Greek words. Maybe they should once use Turkish words for hedge
Exactly.
funds.
Exactly. You should do that.
Yes, and not Greek words. But so far it's doing fine. So that's the first evolutionary finance hedge fund which is around in the world.
See, even Thorsten, even Porsche is using Taycan, you know, the Turkish name for his new electric
that's true,
car.
Yes, Porsche is more advanced. They use Turkish names, yes.
Exactly.
Okay, so finally, Serkan will share the slides with you. So if you want to read more, there are all these publications which are used for the presentation. And now I have run out of steam. So thank you very much. Thank you very much for listening.
Thank you. I mean, it's a great honor and privilege for us. It was great. Thanks a lot. I mean, I couldn't understand how the time passed. So
yeah,
it was
I have
great.
So many things to say. So maybe I should once come to your university and give a course on this, huh? Because it's fascinating things.
Definitely. I mean, as soon as this pandemic situation ends, we will be honored to have you here again. I mean, it has been, before we start the live chat, we were discussing with Thorsten that we have met him about 7 years ago, I think. His first lecture in Commerce University was about behavioral finance then, but we got the promise about evolutionary finance back then. See, we are following for 7 years. So thanks again for this great presentation. And I believe, actually, I kind of used the audience's question and answer section time period. Sorry about that, but I just wanted to listen to you more.
But they can always send me an email, right?
Yeah.
If somebody is interested, he or she can send me an email. I will answer it. I'm quite happy if somebody is interested in my research.
It sounds great. Just like a quick last question. I was curious about the sample set, especially the empirical ESG study. In the study, you said that you used 14 developed countries, and especially, I think, large cap stocks. Is there a certain reason for that, or are you planning to make another study for the developing countries, or you're avoiding that because of lack of ESG data?
So the ESG data doesn't cover so many small companies and not so many developing countries. Huh?
Yeah.
So that's a problem. But over time, it might get better. So more and more will be covered over time, and then we can check it again.
Because I was curious about the whether there are any different dynamics between the development versus the developing countries. If I recall correctly, South Africa, there are certain regulations for companies to follow sustainable investing issues, and they have to, as a mandatory obligation, to publish.
You see, this is already interesting further research, right? So now exactly. Somebody from Turkey, for example, can study this in particular on Turkish companies, right?
Yeah, I hope so.
No, so the theory is there and the algorithms how to compute. The only question is the data. So if you have good data, you can do this.
Okay, sounds great. Thanks a lot. Thanks again. I hope to see you in Istanbul again soon, hopefully next year, maybe. Yes. And thanks again for joining us and for all our friends listening to us, colleagues and students.
Yes, thanks for inviting me. Bye-bye. Keep safe.
You too.
Bye-bye.
Bye-bye.